Welcome back to Get Paid for Your Pad, episode number 560. We are your hosts, Jasper Rivers and Eric Miller. And today we are talking about how to analyze short-term rental acquisition deals, as that's what Eric and I are basically doing every day right now, looking at hotels to potentially buy. So excited to dive into it. What's up, Eric?
What is going on, man? I'm excited to chat about this. This is it's a hot topic right now, man. Seeing the industry move into boutique hotels and a bit more control of the asset. So yeah, it's gonna be fun to chat about this because I know we're gonna get a lot of emails saying that people are doing the same. So it's gonna be good.
Yeah, 100%. And we are currently looking at a number of hotels to buy for FreeWild. I'm personally taking a course as well. It's called Adventures in Corporate Real Estate, CRE. Very comprehensive course. So we're kind of learning a lot just from looking at deals, but also from going through this program. And you're going through a program as well. It's called eCornell, is it?
Well, yeah. So it's I'm going through the investment and what's the name of the title of it? I should probably know that. But yeah, I'm joining the eCornell program. Obviously, Cornell has a world-class hospitality program in the university. They have a great online university as well. So I signed up for a handful of their courses. So I'm going to be going through that for the next 6 months. And it's really understanding how to invest in hotels at a high level, but then also understanding how to manage a portfolio at a high level. So there's a lot that I'm going through now, which is very eye-opening. What I learned from this too, and this is just a good reminder to constantly invest in education and learn from people that are doing, actually doing it at a high level. The numbers that I'm studying that they're using as case studies in this program are so freaking massive, $500 million deals, $1 billion portfolios, right? So they're educating at such a high level. So it makes it look like, for us, it makes our goals so much more attainable and realistic. And I'm like, okay, well, maybe we should stretch it a bit more because there's so many people playing at such a higher level. And if you're not introduced to it, you don't know what's actually possible. It seems like it's out of reach, but I've been in the program for a few weeks now, and yeah, just the numbers are blowing me away. And the people that I'm in the class with, I get to communicate and connect with, and these are individuals that are, working for some of the biggest hospitality companies in the world that are going through to get, refreshed to up level their position. So, yeah. It's a lot of fun. I'll probably do some, maybe when I get deeper into the program, we'll do a podcast on some of the learnings I'm getting from this. But let me see here. It's just so if anybody is interested in this, it is. Yeah. How to investing in hotels and portfolio management. So yeah, next 6 months.
Yeah, you make a good point because numbers can be a little intimidating, right? We're looking at hotels that are like 4 or 5 million, 3 million. But in the course that I'm going through as well, they're giving examples and they make you do case studies. So they make you build like acquisition analyzing model in Excel for deals that are worth like 50 million. And the way they talk about it is very casual. It's like, okay, we'll do numbers here and there, 55 million. And it definitely puts things kind of in perspective, right?
Yeah, 100%. Because when you're looking at, I remember when I first got into real estate, I was buying houses for like $100,000, $200,000, $300,000, and I bought a house once. This is maybe 15 years ago. I'll never forget it. I bought a house for $425,000, and I thought it was the most. I was blown away on how much money we had to raise to go and buy this house. And we put $100K into it and sold it for 6 something. And I was just like blown away by those numbers. And now looking at these, I'm like, oh, okay, $4 to $5 million acquisitions. If you're hitting the numbers that you need to hit, it's not that difficult to put together. but then I also realized, like, if you can buy and manage a $4 million hotel, you can buy and manage a $15 million hotel, and $25 million hotel. Like, it's all the same ingredients. It's just it's a different type of mindset and intention that you're going behind it. So yeah, highly recommend, if you guys want to continue. And this is the first time that I'm going back into a program. I've invested a lot over the years of, like, online courses and, for $1,000 here and there. And, those are valuable, but the programs that we're in are significant investments, not only of, money, but the time that's committed to this. And yeah, I mean, I haven't been in school in a very long time, and this is a legit school program, being graded, tested, the whole thing. So yeah, it's just like investing into that and surrounding yourself with people that are actually doing the industry, doing what you want to do at such a higher level, just helps you realize, one, the ceiling that you set for yourself when it comes to what you can do in business, but then two, it unlocks this whole other level of, potential in what you want to do. So now that I'm going through, like, how to, risk management of a hotel portfolio of, $500 million, and going into next week, we're going into a portfolio discussion of $1 billion hotel portfolio. It just makes you think, you're like, oh, okay, there's nothing different here other than the numbers and then the quality of the people and the execution behind it. So yeah, it's fun, man. So, but let's dive into it. Let's kind of update everybody on what we're doing and where our focus has been going within the hotel side.
Yeah, and first, to give some context, the reason that we're talking about this and the reason that we're both kind of studying this is we recognized, for us to build FreeWild, like a big part of us being successful is us being able to do really good analysis on hotels, right? To really understand, like, okay, what kind of numbers do we need? How do we analyze these hotels? Because there's quite a bit of complexity to it, right? And what I'm learning in my course is there's no one right way to do it.
Mm-mm.
There's not, like, when we got into this, like I Googled online, like, okay, hotel acquisition Excel sheet, hotel acquisition model, that we can just take and that we can just implement. And as I'm going through the course, they're explaining, like, hey, there is no one model that everybody could use. You got to build your own model. So that's what they're teaching me in the course, is like, okay, this is how you build the model, and over time you fine tune it to your own needs, and the numbers that you need that are important for you, and however you want to build it. Obviously, there's certain numbers that you always want to be looking at, like cap rate and return on investment, internal rate of return. There's all the standard metrics that will show up, but we recognize, like, it's so important for us to be able to become experts in analyzing these deals, because the better the deal that we buy, like the better the easier it is for us to be successful with this business. So it's a really important aspect of it.
Yeah, I think that's the first takeaway of this is I always thought the same when I look at these companies, and everyone kind of who follows the podcast knows, like, I've been studying, what I believe to be some of the best hospitality brands in the space, boutique hospitality brands that are in the short-term rental space and doing what we want to do with their own unique flavor. Is that I'm looking at it, I'm like, oh, they must have a certain way that they do it, or there's a certain set of how we run numbers on properties and making decisions. So I think that's a great takeaway, is understanding, like, yeah, there's some basic ingredients to every single good investment that you go into that, have to check the boxes, right? Consistently. But then there's also your unique approach to your brand and what the ultimate vision is of what you're developing in your portfolio, and understanding how to manage, the returns versus risk of each property and how that affects the portfolio and everything else. So yeah, I think that's the first takeaway, is like, you got to understand your numbers, but then there's definitely, the basic ingredients to those numbers, but then also you have to really understand what are you bringing unique to, what do you actually need to know for your own business and the ultimate goal within those listings. So, or within those projects. So yeah, there's not one right way of doing it. I think that's a great takeaway.
Yeah, 100%. And I remember when we were in Mexico, we actually had a couple people who were doing kind of a training on how to analyze deals, and they also started with like asking everybody like, hey, what's important to you when you're looking at a deal? And there's like 15, 20 different answers. In my mind, it was just like, well, it's all about the numbers, right? But there was like, all these other factors. So I kind of wanted to go through some of the most important ones just to give everybody an idea of like how we're approaching this. I would say, let's start with the first one. The first thing we look at when we find a deal, and you've been looking up the deals, and maybe you can kind of share where you're finding these deals as well. But I think the first question that we ask ourselves is this property in alignment with our brand, right?
I'm so happy you said that, man.
If not, we're not going to even look at it. There's no point.
100%. Yeah, because I was interested to see what you were going to lead with, if it was going to be numbers, right? Because it's like, oh, it's got to make these numbers, right? But what we've realized is by looking at all the, every single day I carve out time in the morning and at night. And then when I'm bored or whenever I have some downtime, instead of going on social media or doing other things, I'm on LoopNet and looking at all these other websites looking for properties. And it's becoming fun because what I realized with the hospitality brand, what we're building with FreeWild is like, we can go anywhere in the country to do this. And it's freaking awesome, man. I'm looking at properties everywhere throughout the country, which is amazing. But the very first thing that I look at when I'm finding these properties 100% is, would the Wilder, which is our guest avatar, would the Wilder travel to this property? Are they seeking that, right? So like, for example, I found some really good investments in Nashville, really great properties. They were brand new built, ran as short-term rentals, very successful, great locations in Nashville, have the license and permitting, all of that for the properties. And I saw a lot of opportunity for us to increase revenue and the experience through the marketing and through the design, right? The builder did a great job, but you could tell that they were not hospitality focused, right? And I got pretty excited about it, and we started running numbers, and I'm like, okay, the numbers make sense. Yeah, the investors would invest into this, but then I had to take a step back, and I'm like, hold on, now we're building two different businesses here, because the Wilder, our guest avatar that would travel to our property in Idlewild, will have a completely different experience if they tap into this property in Nashville, right? And then equally looking at this hotel that we're doing numbers on now, in Washington State, I'm looking at that. I'm like, okay, this is a great property. It fits all the boxes of what we put together in our acquisition packet, the portfolio of our, the profile of the property that we're looking for. So the very first thing that we're looking at is like, will this support the brand or distract from the brand? That's one of the most important things, because you can buy these great investments. And I want to clarify too, if you're looking to just create a portfolio of performing short-term rental properties and you're not focused on brand and you're okay with having different mix of assets, as long as that's your portfolio vision, that's completely fine to do that. We are focused with FreeWild. We're focused on creating a lifestyle brand that is serving a unique set of travelers, right? That will connect to our brand, connect to the properties, the locations, and kind of identify with the brand. So they're seeking out these locations. So the very first thing is, does this fit the brand, and will our guest avatar seek this property and be excited to stay at that property? Because from there, then the value of the brand starts growing. And that goes into the conversation that we had last week of, developing the asset between your brand and your propco and opco. So 100%, does it fit the brand, and does it fit your portfolio strategy?
Exactly. And, things that we're looking at is, number one is the experience, right? Like you said, like, it's our guest avatar, the Wilder. Is that person going to be excited about the experience that this property offers? Or can we create an experience, and can we change the experience so that our guest avatar is going to enjoy it? The location obviously matters as well. We want to be a couple hours drive from like major cities, right? And then the type of property as well, right? We want to
But
have
also,
unique strictures.
yeah, but also the location for us, and this is unique to us, right? So obviously in real estate, location is always the first thing, right? For us, our location is being 1 to 2 hour drives of metro areas in nature inspired locations, but also close to a local town that is drawing people to that location, and then also access to nature that's also drawing people to that location. We're finding properties that are perfect for the brand as far as like the structures and the land and what we can add to it, but it's so far outside of why anybody would travel to it. There's no downtowns, there's no little cute mountain towns anywhere, there's no restaurants, and that creates so many major challenges for the brand that we're trying to create and what our avatar will be used to in our other properties. So yeah, the locations have to meet your portfolio structure as well of what you're looking for.
Yeah. Yeah, 100%. So that's really the first thing that we look at, right? If it doesn't align with our brand, then we're not going to waste money of time, diving deep into the numbers because it just doesn't make sense for us, right? So if it aligns with our brand, then what's the next thing that we look at? It's then we start looking at the numbers, right? Then we start looking at like, okay, makes sense. And looking at the numbers it's kind of, there's a lot that goes into that. Like as I'm getting deeper into this course, I'm starting to understand there's so many different things. It's not just the cap rate, it's like really digging into the revenues, right? The historic revenues. Can we increase those revenues, right? Because we want to look at the numbers based on historic, but we also want to look at projections, right? Can we increase these revenues or not, by putting our brand on top of it, by upgrading the experience, but then also the expenses. Can we lower the expenses? Because if you can lower expenses by 10% and you can increase revenue by 10%, that has a massive effect on the purchase price that we will be able to pay, like a big effect, So that's kind of what I'm learning with the numbers is like, we have to go really, really nitty gritty. And even if it's something that we're not interested in buying, like I'm still excited to kind of do a case study with the numbers just to get more experience. Cause that's one thing I'm realizing too. For us to get really good at this, we got to do this every single day and just keep practicing. Right. Yeah. And at some point you're going to start, you start seeing like things that you didn't see in the beginning. Exactly.
Yep.
It's like, oh, this project, they spend, their 15% of their revenue goes to cleaning, for example. Mm-hmm. Right. This project is only 10%. Hey, that's interesting. Like you get a feel for all those numbers and then you start seeing the opportunities.
Yeah, two things on that. One is I might have mentioned this on a previous podcast. Grant Cardone was asked the question if he had to start over again at 19 years old or 20, whatever the age was, and he wanted to create what he has created in real estate, what would he tell himself? What would he do? And he said he would every single day analyze as many real estate projects as possible. He's like, every single day I would go and do my work to pay for my lifestyle. But any downtime I have, I'm not looking at social media. I'm not looking at TV. I am going through deals and analyzing deals to understand how to value real estate. And that is one of the most powerful things you can do if you're stepping into this to acquire wealth is you have to understand how money works in real estate. You have to understand, and the only way to do that is to be active, right? And it's like anything else that you want to become great at, or even become good at, you have to focus on it every single day and just go through the patterns, right? It's like what Stephen Pressfield talks about with turning pro, going from amateur to pro. It's just like every single day I know what my work is. I just show up and I just do that work regardless of how I feel and how exciting or not exciting it is. So yeah, I mean, that's why I'm getting I'm working in every single day to analyze deals from that perspective, the skill set that I have of seeing like, hey, will this fit the brand? Location, structures, can we build, pulling out the info from the realtors and the investors or owners, and then getting that and passing it to you for you to do your thing of finding the patterns in the numbers, right? And the opportunities in the numbers. So you got to be freaking great at doing that every single day.
Yeah.
And then lastly on that point is, Grant talks about going through that, but two, it's like, as you start going through this, you find the patterns in the numbers. Those patterns will open up questions, and those questions will open up opportunities, right? So, if you go on loopnet.com and find a property that you like, a good broker is going to put together an incredible amount of info, right, on these properties, information packets. You sign an NDA. Everyone makes you sign an NDA for whatever reason. They send you the financials on it, and you have all those details. But the moment that you start going through the numbers, you will find those patterns, and those patterns will lead to questions. Those questions will lead to an opportunity to either buy the property, get a different discount, or finding where we can increase the value of that property, right? So like the one deal that we're looking at now, it's like, was it like $200,000 in owner expenses? And, we're looking at it and we realize like this person, and that's why I love this asset of these old vacation rental communities is, the mom and pop operators spend so much money operating these properties. And by converting them to a modern short-term rental experience, we can streamline a lot of the operations and save quite a bit of cash there and be able to invest that cash into the right people to run that property to bring it to the next level. So yeah, I mean, everyone's got to get good at running deals. And this is good. That's good advice too for the people that are doing management and rental arbitrage, even though I don't believe that you should be doing rental arbitrage anymore. But if you are, it's like, and you're doing the management side, find properties that are for rent, find properties that are out there, and just run numbers every single day on understanding, will these things perform? And then those will open up opportunities for you.
Yeah, exactly. Well, it's pretty insightful just to go through like the expenses, just to see like, oh, they are spending X on marketing, they're spending X on insurance, they're spending X on supplies. How much are we spending on supplies? And then it's very insightful. Yeah, I agree. Even if you're managing, just it's really interesting to see those numbers. So let's go to the next kind of bullet point here. So we talked about it has to align with our brand. Numbers have to work, and when we say numbers have to work, what we're really looking at is can we generate enough profit to pay our investors what they want to make, and still have pay ourselves, right? Have our management fee for FreeWild, and then have some profit for ourselves as well. So that's really what we're looking at. But then kind of hand in hand with that is something we talked about yesterday is there's a lot of different ways to finance the deal, and the numbers are going to really depend on the scenario, right? Are we doing cash only? Are we able to get a loan? Are we able to get owner financing, which you mentioned, and it's very popular these days? And maybe you can explain why owner financing right now is very common.
Yeah,
and explain what it is for the people that don't know.
For sure. I mean, our friend, what's his name? Drawing a blank on his name. Well, anyway, he was on our podcast. We were chatting with him about it 3 years ago. Jason Hartman. Sorry about that, Jason.
Yeah.
Jason was telling us, he's like, listen, man, like the real estate is not the asset. The mortgage is the asset. Like he was saying this 3 years ago. And he's like, the mortgages are the asset. And I didn't really understand it at the time because the market was on fire and growing. But his philosophy behind this and vision behind it was like, at some point, they're going to stop giving out 1 to 3% mortgages, and the interest rate are going to grow. And that's what we're seeing now, right? Is like interest rates are, doubled in most places, for most assets, right? So what's happening now is the mortgage rates, where are they at right now? 6%?
Yes. Well, 6-7%. Yeah.
Yeah. So right around there. Now, because you have a higher purchase or interest rate, obviously you can't, your buying power is less. You can't spend as much on that property, but the owners, the sellers still want a higher price. It hasn't really, there's not a crash that has happened. There's a battle that's happening between the seller and the buyer right now. What the buyer can actually spend and what the owner actually wants from it, right? Especially these hospitality properties that are coming off of these incredible last 3 years of bookings, right? So a lot of these owners, especially for the asset that we're going after, they've owned it for a long time. They either own it free and clear, or they have very low interest rates on these properties. Now, what we can do is when we go to make these offers, we could either offer to acquire everything cash from our investors, and obviously, that the goal there would to be buy cash at a discount, close fast, get it cash flowing, reposition the whole thing, put a long-term mortgage on it, take our investors' cash back out and go buy another one, right? So the benefit there is moving fast and buying properties at discounts because you have buying power there. Two is, obviously a traditional way of buying is you put cash down 20, 30%, whatever it is. And then you go to a bank or whatever, you get a mortgage for the additional amount, you buy the property, right? Traditional way of buying it. Challenge with that is just the time and just all the drama that comes around getting a mortgage to acquire these properties. And then three is some type of creative financing. And creative financing right now, in my opinion, focusing on seller financing is going to be a huge way where you can buy these properties at somewhat of a discount. The owners over time will be able to realize the number that they're actually looking for because they have a mortgage on the property. But then you, as the investor, we don't have to bring as much cash to the table or bring as much of a mortgage to the table, right? So, for example, the property that we're going to put an offer on, they've owned it for a very long time. They have a lot of equity in the property, right? So part of the offer will be to hold X amount of the purchase price as a lien to the property. So they will become a bank to us. We'll pay them an interest only for 3 to 5 years at a pretty decent interest rate. Say they have a mortgage of 3% on that property. We'll say, hey, hold $1 million for us at 5% for 5 years. We will put down X amount of dollars in cash, and then we'll get a mortgage for the rest, right? So what happens there is you can buy this slightly at a discount. You don't have to bring as much cash to the table, but over time, the owner can realize the numbers that they're looking for because they're still making money on this property, as long as they believe in you as the operator that's going to really run that property at a high level. So as we're running numbers on these properties, we have to look at every scenario. We have to look at all cash offer and the cost that goes into that money and how long will it take us to reposition to get a long-term mortgage. But then, what is the buying power there is that we can buy cash, buy fast, buy simple, and we can get to the point, right? So give us a discount on the purchase price. Most owners, for the most part, will like that.
So I was, yeah, go ahead.
I was gonna just to finalize that. 2 would be like that mix of traditional ownership, and then 3 would be the creative financing.
Yeah. So one question that came to my mind, I was thinking about this in this scenario, the owner, let's say they have a mortgage, right, at a very good interest rate, so they would actually keep that mortgage.
Yep.
And is that allowed? Are you allowed to sell the property and still keep the mortgage?
Yeah. I mean, obviously there's paperwork and deed transfers, but yeah, I mean, you can do that all day long. So if you have a mortgage on it, there's different ways of structuring the deal, but yeah, without a doubt, they still own a lien on the property, right? So,
Right.
and I'm not a seller financing expert. I've done it a handful of times. I understand the concept, but there's a handful of different structures to it where you can take over the payments, right, of the lien that has happened before, where you take over the mortgage, and you're now responsible for that mortgage, but the owner is still attached to it. Or if the owner has, no mortgage on it and owns it free and clear, you negotiate a certain term and you actually create the lien, you actually create the mortgage and you put a lien on the property, which would be, most likely secondary to the cash that we're bringing to the table or the major bank that we bring to the table. Right. So yeah, you can, there's ways of doing it for sure.
Yeah. And I remember when we were in Puerto Rico, we had a mastermind member. His name is Scott, right? Scott.
Yeah.
You remember Scott, right? And he told me that he purchased a building where he wasn't able to put together the price that they were asking. And so what he said was, hey, listen, I'll give you a third of it now. And then in the next 3 years, with the income I'm generating on this property, I'm going to pay you every month. I'm going to pay you X amount of dollars. So by the end, after 3 years, you'll actually have the full price that you're looking for. Right. Yeah. So I guess when it comes to owner financing, there's a lot of, it's all about just negotiating with the owner, right? There's so many different ways that you could do it.
Yeah.
It comes down to negotiating.
Yeah, you have to, I mean, and this is where sales comes into place, right? Becoming a good salesperson is really understanding what is the motivation behind the sale, right? And most of the time, the people that we're going after, they're owner operators. They've been running these locations for a very long time, and they want to cash out. They want to retire. They're tired of running it, the whole thing, right? Now, once you understand the motivation of the sale, understanding what do they actually need, and this is where the conversation comes from. You have to build that rapport and you have to build that connection with the seller to truly understand it. Obviously, if there's realtors involved, there's ways of kind of managing that, but it's always better to kind of get direct to the seller to understand this stuff. But what I've noticed in the past, and the way that we're going to be building this out for our purchases moving forward, it's like most of the time, if you understand the long haul, people will like residual income. And that's what being a more, holding a mortgage there is like. If they believe in you and your ability to run this property consistently and pay those fees down, you can introduce to them, hey, over the next 3 to 5 years, we'll pay you interest only on this every single month, right? For 3 to 5 years, that equals out X amount of dollars on this. But you take a lower price now. We give you X amount of dollars cash. So you're leaving with cash in your pocket, right? You have monthly income coming on this property, and it's secured to the actual property itself, right? So for the right people that are willing to do this, and I think nowadays, going into the economy that we're going into, and like, I think we can sell it pretty damn hard on the benefits of seller financing, right? Yeah. Not everyone's going to take that, but there are people out there that see the opportunity. So, I think it's something that everyone should be studying right now.
Yeah, for sure. I mean, and it's changed very quickly, because when we bought our property in Ottawa, that wasn't the case, right? It was like,
no, I mean, we bought at the peak, man. We bought at the top of the market, because directly after that, like, properties, two things happened. They changed the short-term rental laws in the area, and two is, interest rates went up, so properties were just sitting longer.
Yeah, for sure. There's good timing there.
It's all good, man. It's gonna work out well. The equity play on that property, and like that being the flagship of Free Wild in the like, we can't get a better location. The property's incredible. It's not as big as we want to go with this, but as an MVP, as a flag, the flagship location, I think it was perfect, and the numbers work very well.
Let's go to the last kind of bullet point that I wanted to discuss, is the value adds, right? So looking at the property and thinking about, okay, are are there additional revenue streams for us to develop? Can we, build extra units, or can we improve the experience by investing in the current units? Right. That's a big factor to keep in mind. And that's one of the reasons why we bought the property in Outerwoud, right? Because it has extra land where we can buy additional cabins, and that's the same. That's the case as well for the hotel that we're looking at right now.
Yeah. Yeah. I mean, every single property that we're going to buy, we have to have some type of value add to it. Right. And there's many different reasons behind it, tax advantages and, equity build, the whole thing. But yeah, our model is acquiring these older properties where they have really good infrastructure, so we can renovate and rebrand the existing units. But then we also have the ability to expand square footage, right? So this one property we're looking at has 10 cabins. They're doing extremely well, but we also have the ability to acquire. They have 2 lots and acquire an additional 20 acres on top of this, and be able to expand anywhere between 15 and 25 new units, cabins on that, right? We did the numbers, and it was like, each cabin made, what was it, 100K per year?
Yeah. So this is a very simple example. This property, they're asking for 4 million. It's 10 cabins, doing about $1 million in revenue. All right, so that's 100,000 per cabin. But if we can build an additional cabin for 200,000, then we're making an extra 100,000 in revenue on an additional 200,000 of investment, right? So that's 2 times the return on investment of versus the original property.
Right.
So it really increases the ROI for us.
And there's, of course, as we're going through these numbers, we have to understand, like, does the market actually have the demand to support 15 and 25 new cabins, right?
Yep.
And is it in a location to where we can actually do the build, right? So we're looking at, I think we were talking about, 500 square feet ish, give or take, of the cabin size, and putting a very high number on construction, which would include everything from, approval to staging, right? So everything through that process of $300 a square foot, which is, it's inflated for that market. But like, even at those numbers, we're like, all right, if we're at that from A to Z, from concept to opening door, then it's a great investment for us. And then you think of the equity play, the value of that property, how much it increases with just obviously the brand and, the optimizing the operations, but then also, adding that much square footage to the property and maintaining that demand that's there. I mean, talk about an incredible exit on those properties if we choose to do that.
Right. Yeah, exactly. Yeah. If we can, if we can double the amount of units, then we're in a few years' time, we could either get a loan that's much higher than what we've actually invested, right?
Sure.
Or we could sell it, but we probably wouldn't sell it.
Yeah, we'll sell a couple.
Awesome.
I wouldn't mind a nice payday from time to time, but yeah, the goal is to build wealth over time, right? And the goal is to kind of hold as much of this real estate as possible.
Yeah, and that wealth building can go pretty fast because we've been looking at some other deals as well where somebody literally bought a property, invested $2.5 million, and then got really good revenue on it, and now it's on the market for like 4.5, right? And you're looking at it and you're thinking, damn, this person might be making a couple million in just a few years.
Yeah. It's that's why I love the real estate game. And I'm telling you, building this short-term rental side, the brand on top of it, like the value of these units just skyrocket. Because let's leave it at this. Like, I'm looking at this one property. I haven't introduced this one to you yet. I'm looking at this one property. It's on 15 acres and it has 4 decent sized cabins that are, I think, 1 bedroom, 1 bath each, right? 4 decent size, and they're spread out across the acreage. And it has approval to build an additional 15 or I think 15 more cabins of that size, right? They're selling this currently at $400,000 a room, okay, for the 4 cabins, right? Equally, I found a hotel that's in the exact same market, right? And this is a small market. I found a hotel that's in that market. It has 37 rooms, right? So much bigger than it's at now, and it's selling for $28,000 a room.
28?
Right? 28,000 versus 400,000. What's that?
28 or 280?
$28,000 a room. So they're selling that at $1 million, $1,050,000. Wow. Right. Now, the reason why I'm bringing this up is like the difference and the cap rate on this property, you know, the 37 room is, you know, they're marketing it at 12.38. But the reason why I bring this up is there's the value that we can increase on these properties as short-term rentals versus a hotel. It's such a different, it's a different asset class, right? And the value that we can create by creating these boutique experiences and the demand that we can get in those properties versus what a traditional hotel can get in a similar market is freaking unbelievable, right? And I was comparing those two. I'm like blown away because it's in the exact same market. There's not a lot in that market, but the 4-unit hotel, short-term rental hotel with the ability to expand, which will still be less than what this traditional hotel is marketing, attracts such a different avatar at such a different rate consistently versus a regular hotel, right, in that same market. So the value play, in my opinion, is just, it's a fun industry to be a part. This sector of the real estate industry is so fun because we're kind of carving out our own asset class in this space.
Yeah, I thought you were 0 off or something there on there, but
no, man, I was blown away by it. And it's a good looking hotel, you know, but it's a traditional hotel. I would pass by it, you know. It's a regular hotel, bed, bathroom, you know, like it's nothing special, right? But it's nice, and they've been doing a good job, and it's massive. But, you know, this is a perfect example. Their daily rate on this is $64 to $84 a night, where the other property is $100 to $250 a night.
Interesting. So you can still get a room in the US for like $60. That's good to know.
Oh, dude. I could show you some hotels, man. You get it for $10 a night. But yeah, man. So that's it. Hopefully, the listeners found this valuable, and of course, we want to hear from you guys. We want to learn from you guys. We don't consider ourselves experts here, but we're on the journey to become, you know, very proficient and great at this niche of what we're in. So we want to hear from the people that are currently buying boutique hotels, the people that are currently building these cabin communities, unique structures, things like that, people that are building unique brands and have similar ideas and buying real estate, raising money, the whole thing. So just reach out to us, and love to chat with you. And, you know, we'll continue to share this free wild journey with everybody.
Yeah. 100%. This is going to be a big part of what we're going to be focused on in the next few months. So yeah, excited. You're going to go snowboarding this weekend?
I'm going to try. We're flying up to Mammoth Lakes right now, which is about an hour flight. And yeah, we're staying up there. I'm going to go look at a hotel that's for sale. It's the only property that's for sale up there. I'm going to try to do some snowboarding one day, but yeah, next Monday I kick into a whole training session. I hired a fitness coach and committed to a 6-month journey to kind of rebuild my body, which is exciting, kind of step into a high level training 4 days a week. So I'm not going to go too crazy because I don't know how to snowboard. And last time I went snowboarding didn't end well. So yeah, my goal is to try to learn.
Be careful. A lot of people break their wrists when they go snowboarding. So
no, dude, I'm going to have everything. I'm going to have the butt pillow. I'm going to have the wrist guards, a helmet. I'm going to have it all, bro. No shame.
All right, sounds good, man. I'm flying out to Bogota for because it's Easter, right? Easter holiday.
Oh, it is. Wait, is it
Yeah,
Easter?
it's Easter
I guess
holiday.
so.
Yeah. So I'm flying to Bogota in Colombia. I've never been there, and we're gonna do some hiking. We're gonna check out some restaurants. So it's gonna be a lot of fun.
Right on. Right. Oh yeah, it is Easter. And
Yeah.
by the way, happy birthday to my grandfather. He turns 102 today.
Wow.
102.
Wow. Congrats, man. That's
Yeah.
incredible.
Crazy old Irishman, still living in Jersey, doing his thing. But yeah, happy birthday, Pop.
All right. Happy birthday. All right, everybody. Thanks for listening. Have a great Easter weekend. And yeah, let us know if you're doing something similar as what we're doing. We'll always love to connect with you. So that's it for today. We'll see you next time. Peace.